Hello, hello, everybody. Brian here on Black Friday Eve. Don't worry, I'm not going to tell you to buy stuff because I'm not allowed to do that here. Anyways, I just want to talk about what I'm seeing in the markets for the last week, 2 weeks, couple of weeks, some other commentary I've heard online. I'm going to lead it with this. I've never seen this before, and you have Bill Ackman announcing he's um, shorting the 30-year Treasury bill. I mean, that's pretty shocking. Like, U.S. Treasury is supposed to be one of the safest instruments in the world. And here's a, I know he can be a short trader with his famous conflict with Herbalife, but I find it very strange on how, hello, Mr. Pepe. Um, Thanks for watching. If you got any commentary, let me know. So as I was saying, I just find it very weird how Bill Ackman decided to short back in August the Treasury um, as the Treasury was starting to move up. And there's some further commentary that I thought I'd mention with Max Kaiser and of all people, George Salente, if you're a fan or not of either or. But it was quite interesting what he said. I'll get in that in a minute. But right now, you're looking at the Treasury here, and you can see it spiking. I noticed a lot of the Treasury was spiking over the last number of weeks. Which what's happening basically is the U.S. debt is getting really out of control, and I've shown this before. If you go to Google, let me just pull up the USA debt clock. Okay, I want to show you some real cold hard facts. I'm not sure if I remember showing this on the uh, the streams here on TradingView, but just generally, let's take a look at the situation we've got right now. You've got a $34 trillion debt and going up. You have a annual budget deficit of 1.7 trillion. If I was to show you a chart of just the U.S. debt, it was always between the 40s, 50s, up until just before in and around the financial crisis in 2008. It was at $2 trillion. So over those 2 decades, you were financing different wars. Had Iraq, you had Korea, you had Vietnam, and that was able to fund 3 wars over $2 trillion debt, which is pretty manageable. And now it's ballooned to 33, 34 trillion, 1.7 trillion this year alone. There's something funny going on, okay? And how, like, this is where I get really, really just flabbergasted what I'm seeing. So you have a population in the US of 335 million. You only have 128 million that are paying tax. So you do the math, that's 200 million people not working in the US or taxpayers that 128 million are carrying. Um, and that's not where it stops there. Plus, you also have 161 million. So, and that's out of 335, right? So, that's something I'm not sure people should be concerned with. But nonetheless, that's where we are at. So, this is where I think we're starting to see the the chickens come home with these problems. So we have US inflation is now at 3.9 and so on. So there was an interview, as I said, with Max Kaiser, fan or hater of him. I do think he makes a very valid point, and I've heard this before, even on Bloomberg. Basically, we have high interest rates, and those interest rates have gone up. And funny thing is, inflation's come back down. Interest rates for the last few months have stayed stable and have not gone up or gone down. But the speculation is that interest rates will come down, which they'll be forced to. That now signals a bad item, a bad signal, credibility, real bad credibility problem for the U.S. Okay, because once you start lowering interest rates, it can be a bad sign to international investors that will have to are looked upon to buy up the debt. So, from what I understand, and again, this is all what I'm hearing. I don't have the proof. Well, let me just show you this article. So, I don't know if you've heard, but Moody's downgraded the debt because of the debt. Uh, so the credit rating was cut yet again by Moody's. So there's the three big credit agencies. So you can see here, Moody's cut outlook on U.S. credit rating on to negative from stable. So it's no longer stable. It's now going negative. So when you look at that, that basically means that the squabbling going on in D.C. with what's going on in terms of just the debt, as I just showed you, there just seems to be no form of, call it austerity, like with what Merkel did back in Germany. So things are out of control. I think the Congress is trying to do something about it, but it's just it's like things are getting out of control. So now you have the U.S. debt, or sorry, the credit ratings getting cut by the U.S., and that's not a good sign. And on top of that, I just went over the U.S. debt clock. So let's see what's going on with. I did mention that if the U.S. Fed does cut interest, and they're now basically having this situation just go up, especially at 1.7 trillion in 1 year, that's crazy. It's affecting other things. So the big one that's going to affect that keeps things propped up for the U.S. is the U.S. dollar. So what's been going on? And this is what I like about TradingView. Uh, Let me just pull this up. DXY. There we go. So with the DXY, that's the dollar index, the U.S. dollar. So what's keeping things propped up is the U.S. debt, and it's there we go. So if I was to show you year to date, there we go. You can see what's happened here between July and early October. The dollar went up. Now it's starting to go into some kind of. I mean, that's a big down move from a $1.07 to a $1.03, and that still may continue. Okay, so when you look at the, let's say, I don't know, the hourly chart, apply maybe a 4 hour might be better, and you apply the standard moving average cross, as in here, just a simple one. You can see here you've got a cross signal or down or sell signal, and you see how far apart the moving averages are between the slow and the fast and slow moving. They're widening. So when they start to widen, that means the situation is getting worse off for the U.S. dollar. So if these start to tighten up, that's a good sign because that means it is showing that it's starting to go into some kind of free fall. If these, as I said, if these continue to widen these moving averages, then there's a problem. So that's what you look for if you are in a free fall. No different if I was to show you oil. That's kind of not in a free fall, but because there's a lack of demand, um, with OPEC because they can control price and supply of oil. That's just an example of what's going on, right? So you're going from $92 to $76. That's like a 20% decrease. So if I was to still apply an SMA cross, okay, you can see there that's a daily. So if I do a 4 hour. Yeah, maybe a 4 hour. Yeah, you can see that there's a sell signal here, and it's tightening up here. The two averages are tightening up, so it's kind of going through a bottoming process. So that's an example of things may start to recover for oil. But here it's different with the dollar. So why do I bring up the dollar, which is important? Because this is what sustains the U.S. economy and just U.S. as a country is the U.S. dollar. So if this goes into free fall and the Fed comes in and starts lowering interest rates, you're going to have a big problem because the dollar is going to start to accelerate to decline faster because it becomes a credibility problem on top of the other big problem is that nobody's buying the U.S. debt. A lot of foreign countries are not buying up the national debt, namely Saudi Arabia, Japan. So what happens is the Fed is then forced to buy up the debt, and if that's the case, or I think Treasury buys up the debt, and then that becomes a big problem because now you're starting to monetize the debt, and that heavily impacts the dollar. So this could accelerate into a bigger decline. So this started November 3rd. Okay, so if this starts to bottom out, it'll be okay, and that's going to be dependent on the markets for temporarily. So if I load up SPY as an example, so as long as this starts to improve, this should help improve the dollar situation. So as long as that holds, we're okay. Um, and that's kind of like what's been helping to alleviate that problem. So everything does come down to the U.S. dollar, okay, on the situation the with with the U.S. economy. The other thing to watch for is inflation. So we can look at a couple of examples. So oil is one of them. So right now, oil is lower. So that means there's less inflation for the household. But the cost of food, like let's say sugar, um, if it'll load up. No, I'm gonna just look at CFDs, which mimic the futures market. I like looking at sugar. So sugar, as an example, has been on the tear. Sorry about that. So that's been on a tear. So let me just free up some memory here. Okay, so we should see some improvement on this computer. Okay, there we go. So there's sugar. We'll load up. Is the Wanda somewhere? Yeah, so we'll load up just the Wanda just for the fun of it. You can see, even though sugar has gone up a little bit, 25 cents to 26 cents, but peaked at 28. So the cost of food, like staple food, has not really changed. Okay, so you're at 20 cents to 26 cents. That's what? Over 20% of inflation. Okay, so you're not going to hear this from the Fed. They'll outright probably lie to you. Another one, this one's not so bad. So if I show you wheat, um, obviously this one's come down. If I show you, let's say year to date, that's in decline. So that's good. So there's that. One thing I will tell you that people are not knowing about is this might be more of an encouraging sign is copper. Let's see. Let's see here. I hope to get this XUSD. Um, Surprisingly, there's no copper. Let me pull up the other platform. So I'll bring up Yahoo. So hopefully this will come up. So yeah, there you go. So this is copper now. And copper has been on a tear as well. Uh, well, I don't know what's going on. This computer. Okay, so you can see it's actually moved up quite a bit. So if I show you 1 month from 1.3, 6 month, I don't know why 6 month not showing, but generally copper's been moving up. That's an encouraging sign because that is an input for a base metal. So when that starts to move up, that might mean that manufacturing's putting in orders, and that's from Australia. That relationship is from Australia. So there was a big meeting between the Australian prime minister, premier, with Z in China, and what's happened is looks like China is now ordering material now again from Australia. So that cool phase that China put on Australia that's come to an end. And it's also improved the Australian US dollar as well. Let's see here. You can see it's gone up as well since October. So when that's moving up, that's going to improve the Australian dollar, the Australian economy, and that's because the Chinese are ordering minerals from Australia for most likely early input on orders for manufacturing of whatever heavy industry that China's involved with, including copper. But that will impact the U.S. because it's an increase for them. But from China, that's a good thing, as I said. And not only that, but when you look at the Australian US dollar, as the dollar weakens, I think I follow through with hot flow capital. And what I'm seeing that there's more um, the US China yuan. Okay, so remember the US dollar is falling for the last little while. Maybe I can pull up a month. So you can see here that the Chinese yuan strengthening against the dollar. And that's again, I think, because of the Chinese economy may start to improve. I can't say, but based upon what I just shown you, it's starting to improve, and then that comes at a cost for the U.S. Okay, and also what I was saying about the hot capital flow, more money seems to be being poured into both China and Australia for their material. The stock market. I'm not sure if I can show this. Okay, so if I bring up, let's say, the SPY again, or just to do a comparison between that and the Australian market. So I'll bring up a 3 month chart. So that's been pretty strong. But I like to also compare this against the uh, um, AU 200, I believe. So this is a CFD, but just as a comparison, that for a little while that the Australian market was doing a little better. But overall, this is what's keeping things going for the U.S. right now. So, question is, well, what will happen over the next few months for the U.S. markets? I think that for the U.S. markets, it will strengthen, and that will continue to keep the economy afloat in the U.S. But it's fundamentally, I would worry about the dollar. I would worry about this debt situation. I just found out today that they have to renegotiate the debt again to keep the government open, but it's two deadlines they have to deal with in January and February, not one deadline. So they have to go through two rounds based upon how it was negotiated. But all they're doing is just kicking the can around. They're not taking real action to improve the situation in the U.S. government with all the debt that I've shown and situation on the uh, on that U.S. debt clock. And also, when you start getting news about the Treasury being shorted, that's not a good sign. One other thing that was mentioned by Max Kaiser was the bonds. So again, I like using CFDs just because they mimic the real McCoy. So if you look at the 30-year debt, um, let's see here. I don't think I have it. So let me pull that up in Yahoo. USB 30 year. So this is now Owanda. Um, 30-year. It looks like, yeah, it looks like TradingView does have it. No data here. Um, Not sure that, yeah, I guess they don't have it. Um, Let me see if Yahoo Finance, what would be a good source? Oh, yeah, we can go to Owanda itself. So this might bring up a chart. So again, we're using Owanda. So this is Owanda. And I mentioned this in my last webinar on Monday night. Whereas if you pull up a 30-day, um, this is accelerating. Um, let's see here. So the basically what Max Kaiser is saying, that the long term 30-year Treasury, it could be in trouble because of a yield curve. It's steeper than normal. Also, short term debt's still okay. But when you have these situations of just general Treasury being shorted, um, now again, I'm going on speculation when I'm hearing on Bloomberg how the Treasury is more volatile. That's a big concern as well. So there's that, and this situation with the U.S. dollar. This could bottom out for all I know. We don't know. But if, as I can tell you, if the U.S. stock markets continue to improve, just like oil, this will bottom out and then start to stabilize. But I do think if the markets do decline, I'm hearing through different Keiko and Stansberry research from those analysts. I do know a lot of them are doom and gloomers, but it's quite possible you may get anywhere from a 20% to 50% stock decline, like in 2022. If that's the case, I think that will kick off something pretty ugly with the dollar, because all the so-called safe havens are just not there. The Fed may not be able to be in a position to save the day, and if they do, they just basically worsen the situation by adding more debt onto the balance sheet of the U.S. government, what they owe, and then that just drives up interest rates long term, and with with interest rates, and the dollar will probably still decline, and inflation will definitely continue to move up. So there are those things to kind of worry about fundamentally for the economy. So hopefully the stock markets stay stable. But then the next question is how that affecting gold. So if you look at gold, you're looking at 1938, November 23rd, and it's starting to spike again. And you've had some pretty good run ups since Thursday, and it's just running up as well. So if I was to do, well, let me do a 5 year. So you can see here, it's been pretty elevated, pretty good. Kicking at 2000 at different points. So this could break through. Whereas one of the things, oh, it did hit an all time high. So here, people would go, well, look at what happened in 2011. Gold went up, declined, and now it's starting to stay pretty elevated because this is the danger zone, I guess we would call it. Another way to look at this is what I look at is the gold silver ratio. I don't know if I'll go over to Yahoo for that. So I know that exists. So XAU, so that's at gold, silver. Okay. Let me see if TradingView's got it. Yeah, they do. Okay, so cool. So if you look at all time, and I always use this, okay, always use this. So this is 2008, and this just tells you global risk where everything's at. This is what I would use for reliability in global risk overall. This ratio between gold and silver is very reliable. Again, 2008 financial crisis, it peaked. Fed pumped money into the economy, little bit of debt, not too much, maybe 1 or 2 trillion. Who's counting, right? And then that brought in a lot of wealth for people that were the smart ones between 2011 all the way up to 2020. Then the global sickness hit. And you can see what happened there. $6 trillion now added to the debt. Who's counting? And this is now organically. So as you can see, the impact is not as great as it used to have here at 1 or 2 trillion. This impact is one or 2 trillion added to the debt since 2008. You can see the huge impact that it's had, right? Huge run up for close to 10 years. The global pandemic hits, boom, they pump 6 trillion, and it had very little effect. Very little effect. And look where we're at. We're just range bound now. So when you look at, let's say, the 5 day, this is because when the markets perform, this will decline, which makes sense. But it has been elevated for the last month. Okay, so when the markets perform, this comes down. That's what it's supposed to do. That shows reliability in this metric. But once you start to see, as I said, over the last few years, especially these kind of spikes, you got a problem. So what I've already talked about, treasury spiking, that's not good. The debt spiking, that's not good. You got the unemployment's going up because there's fewer people in the tax in the workforce. Okay, here again, number of working or taxpayers versus the total population of the states. You've got a declining U.S. dollar, so things are fundamentally not looking good. And to confirm it all is when you get the gold is now pretty well at an all-time high. Okay, going back all the way back to 1971. Okay, so that is where we're at with this situation, and it's not just the U.S.; it's global. Because what goes on in the U.S. pretty well, it's like the famous saying: when the U.S. sneezes, the rest of the world gets a cold. It's the same thing. So it does have a huge impact on the rest of the world. Whereas, hopefully, maybe, just maybe, that the Chinese economy may start to come back and start to stabilize things. Um, Potential. I'm not saying it will or won't, but they got a lot of fundamental problems over there as well. So there's that. And now people are going to go, why is Bitcoin on the move? Well, there's a lot of reasons. Let me pull up a different time frame here. That's one of my ideas. So yeah, let me pull up. Okay, so I'll pull up Bitcoin and the impact on Bitcoin. Oh, before I forget that, I want to show this chart. I want to show you a comparison between this and poor man's gold, which is obviously um, poor man's gold, which is silver. This seems to be outperforming gold over the short term. Okay, so all time high, you can see the difference to 3,000% versus 435 since, let's say, 2004. Okay, so let's go back year to date. So gold is still outperforming silver, 5 day. Now you start to see it. 0.5%, 0.6% to 2.5%. So gold is now outperforming, sorry, silver's outperforming gold, right? So don't ask me why that is, but I'm seeing more currencies signals for holding silver than I do for gold. That might be, as I've said it before, that gold is suppressed, like at trading desks, and many banks have been fined for that, right? So there's that. Cool, cool, cool. All right, so let's take a look at Bitcoin now. So Bitcoin's been on the move. Okay, you can see here just the difference between. I mean, look at silver, just how much it's come up in the last what couple of days. So that might say something. I don't know as a signal, but silver's on the move, and Bitcoin generally has been spiking. Let me pull up the 3 month chart. As you're going from here 23rd, the 16th at what's that? Buck 38% return, and now we're at 42% return just in the last. So it's spiked, and when you look at these timing, this is because of these wars, and I mean, what was it, October 7th? So a week later, Bitcoin takes off. I mean, this also has an impact from the ETF for Bitcoin from BlackRock and all that. So there's that. But fundamentally, I think Bitcoin is going to be looked upon as crazy I'll say as a safe haven. So there's that. So always people are going on about gold, silver, Bitcoin moving forward, and I've just shown you the chart for gold in the last little bit. It's spiked. It's pretty volatile, but the price has stayed in place for around $2,000. So it could spike. So you may want to dip into some gold stocks and whatnot. As I've said before, if you do want to know about really good um, stocks, this one's pretty good. Osisco with a royalty on top of it, and you can see, boom, it's moving up to 12 bucks to $14. So, and you get a royalty on top of that. So if things continue to deteriorate as they may with the dollar, this uh, may be a good investment. Okay, so coming to that, I'm just gonna leave it at this with Bitcoin and Ethereum. So Ethereum is starting to outperform Bitcoin. So as an example, I'll pull up Ethereum, and another one that's been performing really good is Solana. Okay, Solana has been doing incredibly well. So let me just pull up Ethereum. Boom, there you go. So you can see now Bitcoin has done fairly well, 40%, 25% for Ethereum. But if you do a 5 day, you'll start to see that Ethereum is eking out percent wise with Bitcoin. So it's flipped. So Ethereum may take off. It depends. There's a variety of news for that as well, namely its ecosystem. So I just wanted to just highlight that Ethereum is outperforming Bitcoin. But the granddad that's been doing pretty amazing. It's Solana. This one, look, Solana just spiked 7%. But if you look at let's say a 3 month, nobody can compare this. Everyone's got their eyes on Bitcoin, right? So it's 44%. So they'll put money into Bitcoin. And I was on one of the streams for one of the bigger traders, and I said, "Well, what do you think? Do you think Solana's outperforming Bitcoin?" And this is just like a week ago, and he's like, "Well, I'll look into it." And he went to a meetup, and it was a Bitcoin meetup, and he said, "Well, we don't like Solana, so he's going to rely on these people to, have his returns not doing so well, and he's missing out on a 5 time return between Bitcoin and Solana." And then the other one that's been doing pretty good is Chainlink. These are the two best ones right now that have been doing fairly well. And this one's a little suppressed, 98% I'll gladly take, but Solana's on fire. So when you do a 5 day, you can see who the king is right there. Solana's back in game, and I think they'll continue. So I'm going to turn on my bots and probably put everything in this Solana the way it's going. And Bitcoin's going to do okay, but that's where all the eyes are. But these are very large coins. But Solana's doing well. And the thing is with Solana, Everyone's looking for the 3-time return. So if you do a 6-time return, let me get rid of these. So, like I said, you got about 157% return with Solana. I don't know why people want to miss out on that, but hey, anyways, let me get rid of these, and I'm going to open up the Solana chart. So, if you're looking for really solid ways to do really well, Solana, man, Solana is just incredible. So, when you look at this, where it's $22 and now it peaked at $66, this should remind you of this move. Um, Back in 2020, 2021. Okay. So let me just get rid of these other indicators here. Actually, I'll leave them. So I'll do a 5-year chart. This is what it's supposed to remind you at. So Bitcoin was at 10,000, right? And went up to 60,000 and 65,000. So, Solana's already moved from 20 to pretty close 3-time return at that's incredible. It's like in a very short period of time too, like November and peaking, uh, yeah, in a couple of weeks. It's absolutely like mind numbing. People are missing out on that, and that's all I've been really blogging about on my ideas. So there's that. So yeah, I just wanted to highlight that, um, and yeah, so that's the crypto, right? So as it stands right now, uh, that's what I can show you temporarily what's moving. But the markets, like nobody can be a savant on the on the markets. Let me get out of here. Let me pull up the SPY again because this is what's going to hold things up. Is the U.S. markets. So I'm going to pull up the SPY. Okay. So here we've got our world famous SMA, the crosses on the SMA right there. You got your buy signal, and that was at 199, and that was back in 2017. This is a weekly chart. Boom, there's your big sell right there, and that was in end of October last year. And now we've got pretty well another buy signal here. So will this go range bound or whatnot? I don't know. The best way to gauge that is there is an indicator out there. I'm trying to remember the name of it. Yeah, I can't remember the name, but there is an indicator that will kind of forecast where things will move, and it's pretty accurate. The cycle, her cycle, yeah. So let me pull up the her cycle here. Um, so let's see, yeah, lazy bear, I guess. So get rid of these because this will confuse people. And I will get rid of. So this is a very expensive indicator on other platforms. But what it's saying here doesn't actually give you the full-on cycles. Let me pull up another one here. So Hertz cycle, yeah, this is what you want, the pivots. Yeah, so here's your pivots right here. So let me get rid of this one. Okay, so these are the pivots that you want to look at. Okay, so this is a big pivot right here. These bunch. So what it's predicting is the more diamonds there are, this is predicting a higher range. So this is around December 26. So what it's saying is that this will peak around December 26. So historically, you'd see the different cycles to predict this, but I don't think you can Maybe you can see it as a very powerful indicator. Um, Let me just see if you can see the different. If maybe you got to pay for these. Uh, okay, yeah, they're not showing the proper signals here. But what it's saying is, if I pull up a daily, anyway, so basically right here is the peak of the next cycle, like the next peak of the next cycle, and it'll start to decline. So that's estimated to be around December 23rd, which would make sense. So that's your Santa rally, and it should start to decline. And then your next one may be out here in 2025, December 2025, and around 2026. So that's the next peak of the next cycle based upon historical. So that would make sense, okay? Because I look at the annual reports from companies that they put out and what the analysts are looking at, virtually, like I got a bunch lined up here. So a lot of them are negative. Okay, a lot of them are negative for 2024 and negative for 2025. So a good 75%, and I would say as high as 90%. It's a little better now on this last quarter, but the prior quarter they were calling out 90%. We're saying we're going to have a very bad 2024 and a little better 2025, and then things may start to improve sometime in 2025 towards the end of 2025 based upon these historical Hearst cycles. Now you could change that and go to a daily. So let me just do that and see what that shows. So you can see here there has been some form of accuracy here that the turnaround, the pivot, rough pivots bound right here, the 21st, in around there, and you can see it started to pick up. So will it decline after that? And that's just short term again. So it may start to decline mid December. So you decide which one's more accurate. Okay. But on a weekly, that's probably the better time frame to use. And that would probably make more sense. Right. So that's where the markets will kind of go based upon the Hearst cycle, which is pretty accurate. So if things do decline in the equity space, I do think you'll find Bitcoin may have a pretty good solid year. And I do believe Coinbase look good for 2025 because they're dependent upon the performance of the overall crypto space. So they had pretty good projections for 2025 and 2024. Sorry, got a little whiny chihuahua again. So yeah, so that's kind of in line with crypto and the equity space and the economy, where things may, like the wheels may fall off for the U.S. Um, in 2024 and 2025. So 2024 will probably be a peak year in the valley, and then it'll start to slowly get better in 25, maybe the last half, and then you'll start to see it kind of peak late 2025 based upon this Hearst cycle. Again, it's not accurate, but there is a historical trend there in the Hearst cycle. If you look for that, that's pretty well it. Just me and you, Mr. Pepser. But if you got any questions, let me know. Comments. If not, I'll let it be. It's 9 o'clock my time. So yeah, we'll let that be. Um, so if not, okay, I'll sign off. So that's kind of what I'm seeing based upon the kind of indicators you can use, all within TradingView. But to be able to get that her cycle with for free, and I'm not even sure if that's with source code with PineScript, but if that's the case, it's even better. That's pretty impressive. But that's TradingView for you, right? The good thing. But that's pretty well it. We'll leave it at that. Thanks for watching, and you have a good leftover turkey and Black Friday and all that. Over now. Thanks for watching. Have a good day.